Welcome to the Successfully Unemployed podcast. My name is Roger Wesley, and I am your host. And today I am absolutely thrilled and excited for you because today we have a power-packed episode filled with some education to help us on our journey to becoming successfully unemployed. Let me ask you a question. Are you tired of the 30-year mortgage grind? What if there's a smarter way to pay off your home or your real estate portfolio in a fraction of the time without making dramatic lifestyle changes? Well, today, we have an absolutely amazing opportunity to sit down with the sales manager of First Savings Bank, and he's a leading expert in first lien HELOCs. This gentleman has helped thousands of homeowners break free from traditional mortgages using the velocity banking strategy. Today, please help me in welcoming Mr. Anthony Rushing. Thanks for being on the show, Anthony.
Thanks, Roger. I really appreciate the time and the opportunity to come on and chat with you a little bit and hopefully provide a little value to the listener base and excited to talk with you today. So thank you very much.
Absolutely. And I truly believe that there's going to be significant value because on that journey of becoming successfully unemployed, there are some things that we need to do along the way. And while we all want to take that big jump, sometimes it's prudent and responsible to make sure that we have certain things lined up along the way, whether that's provisions for healthcare or provisions for other things that are going to aid us in our journey. We don't want to cut our feet off from underneath us as we're jumping out in the deep end. So that's why I'm really glad to have you on this episode because I truly believe that our listeners are going to learn a lot. So, Anthony, tell me a little bit about yourself. Where are you from? What types of things you like to do?
Well, I'm originally from Baton Rouge, Louisiana. I moved to Nashville when my kids turned twins and they were one, and have lived in this area. I live in Franklin, Tennessee now with my wife and my three kids. So we love it here. And so that's where I came from. I started my career progression as a musician. Played in a band for a while. We had some decent success. At that point, didn't really see how my life was helping people, which was sort of this existential crisis that I had at that point. So made a move, I left college to do that. I went back to college and actually got in with a group of three guys, and we ended up buying a fourplex and then going into, we used that equity to buy a 32. So I have a little bit of real estate investment experience, but joined a program called Teach for America, which focuses on putting recent college grads in the classroom as teachers and to achieve extremely high outcomes. So that helped me in terms of knowing that my work and my blood and sweat and tears, and I use those words real because I actually did bleed and I did sweat a bunch and I cried too while teaching these kids because it was really tough, but was one of the top 5% teachers every single year that I taught with the kids. And so taught for 7 years and then had my own kids and realized that the lifestyle that I hoped to provide for my children would be really challenging with the income possibilities in education. And there were constraints with that. So I made a move into the mortgage business where doing residential mortgages, I did that for about 4 years. And that was great, from an income side, but still got stuck into this sort of, I don't know how my work is helping improve people's lives. And then I learned about this product that I'm doing now called the First Lien HELOC and the way that people use this specific mortgage product. And when they use it correctly and when it works for them, they can achieve some really amazing results from a debt paydown standpoint and from an interest cost savings standpoint. And so when I learned about that, I was blown away. So made the move there about 5 years ago and never looked back. And so have solely worked with this First Lien HELOC product since that point in time. So I know that's more than what you asked in terms of your question, but hopefully it's not, TMI in terms of context as to sort of who you're talking to. So
No, that was excellent. And I'm trying to be very focused here because I could go off on a tangent on
yeah,
any one of those things. I mean,
I
being
didn't
from
prep you for this
Louisiana
part. I'm sorry
myself,
about that.
because I'm from Louisiana and I went to college in
Yeah,
Baton Rouge and,
that's
that's
right.
so
That's right.
amazing. I didn't know that you were a musician. I mean, goodness
Yeah,
gracious. I
yeah.
mean, music is huge in Louisiana. I
It is.
mean,
It's
the
great.
birthplace of the blues and Louis
Mhm.
Armstrong. And, I could go off into a tangent myself, but I would love to unpack a little further the comment that you made there at the end about the HELOCs, because as a homeowner myself, as I'm actively preparing to leave W2 land forever, it's very important to me to make sure that I have my expenses lined up. And I actually learned this from the inventor of this podcast or the person who created the podcast, Dustin Heiner. He has a book called How to Quit Your Job with Rental Properties. And one of the things he talks about in there is making sure that you are very keen on what your your expenses are and what your income is before you take that big jump in. It sounds like this product may be able to reduce my liabilities in terms of my home mortgage. So that way I would need to create less income from a business perspective to be able to be stable and to thrive. Am I understanding that correctly?
Yeah, yeah. So a first lien HELOC, I take a step back quickly just to help provide context as to what exactly we work with and what we're talking about today. A first position HELOC is a HELOC. Usually when people think of a HELOC, they think of an extension of credit on top of their existing mortgage. You keep your mortgage, you open up a line of credit that you can tap into and access and use if you want. That is a HELOC. It's a second position HELOC. A first position HELOC is one that is in the first lien position. So what that means is it is the first to get paid off if someone were to default. That's why they use the word first or second. In terms of how it plays out or how it functions is if you have a mortgage now, it doesn't open on top of your mortgage, it pays off your mortgage. So it replaces your mortgage. It's a refinancing to one big line of credit. And so the product itself isn't necessarily what makes it that special. It's more about how people utilize it to achieve certain goals. And so what we do is sort of lead with the education on how it's structured, the rules that it follows to help people understand those rules and, the rules you have to work within to leverage those to your, to your benefit as much as possible to help you achieve your goals better with this particular product as compared to an amortized mortgage. So yeah, that's what it is, if that makes sense. And so one outcome that people receive, one sort of pitch that we throw out there is, you can use this to pay off your home in 5 to 7 years. When the strategy works for people and the velocity banking strategy, that term is one that's used. That's simply the best way to work within a first. It's the most efficient way to treat a first lien HELOC when you have it. And when it works, and I can go more into that in a bit, but when the strategy works for people or when people's lifestyles align with the strategy, that's a better way to put it. They can reduce their debt extremely quickly, very, very fast. They can pay down the debt. Once you're paying interest on a very low balance, you're also saving interest too. So if you can arrive at a very low balance, even if you don't pay it off right away, right? If you can pay interest on a $50,000 balance instead of a $500,000 balance in a short period of time, right? What you're doing is you're essentially creating a much lower monthly liability for yourself at that point in time, if that makes sense. So we teach people about how to most efficiently use this and help them figure out if it'll be a good fit. There's another piece to this as well. I usually focus on the debt reduction side of things because that's the thing that turns heads the most, right? The reality is that with this large line of credit, say the home is worth 500,000, we can go to 85%. So you've got a $470,000 line, right? If you owe $300,000 on the house, but your line goes to 470, that would mean that you would have $170,000 available. That's not the right math. I'm sorry. Tried to do good math in my head and I didn't do it.
It sounded pretty close. I mean, I was right with you.
425. I'm sorry. 425. Okay. So if you have an 85% loan to value on a $500,000 house, your line goes to 425. If you owe 300 on the house, that means you have from 300 up to 425 available at that point in time, which can also provide a cushion if things become more difficult. I don't lead with that because if we were to lead with, hey, do you want a cushion if times get tough? What we essentially do is be attracting people who would need to get out of a tough time. Right. Our goal is that people utilize this to help improve and help push them toward their goals as compared to fix the problem. Because if the problem is a spending problem, then that's going to continue to be a problem and putting a Band-Aid over that won't fix the actual problem. Right. But in terms of making that transition, this could also serve as a fairly nice cushion or stability source, right? If things are more unstable at the beginning of a new lifestyle.
Wow. So let me ask you a couple clarifying questions here because, we use this term HELOC and, it's a home equity line of credit, right? Yep. And there's a traditional way that it's being used, but the way that you're talking about is different from that traditional way that it's being used in and of the fact that it actually replaces your mortgage. So this is in place of you actually paying your mortgage servicing company. Is that correct?
Correct. Yes.
Okay.
So the transaction is actually a refinance. So you're refinancing out of your amortized mortgage into a first position HELOC mortgage product. So you can think of it as a mortgage product as well, which sometimes tends to mess with people because they have a very hard definition about what a HELOC is supposed to be. A HELOC is a mortgage product. A mortgage is simply a lien against real estate. And so the HELOC is a lien against real estate, which means it's under that umbrella of mortgage product. It's just not it doesn't have an amortization schedule. So usually people use the term mortgage to be synonymous with an amortized mortgage. However, this is still a mortgage. It just has a different payback agreement, call it. And what we do is we teach people, again, how to leverage that. And so we leverage the differences of how this product works as compared to an amortized mortgage. So there are two main differences. One has to do with money flow. The other has to do with interest calculation. So money flow with an amortized mortgage, you can deposit as much money into it as you want, but it's locked away. You can't take it back out. It's called a closed-ended loan. This First Lien HELOC is an open-ended loan. So every dollar you put in to pay down the balance, you can take back out. Right? It's one main difference that we understand and we leverage. The other difference, again, is in interest calculation. So the way that your amortized mortgage calculates the interest payment every month is it looks at the previous month's end balance, and it uses that end balance against your interest rate to calculate your payment. And that's just the way that it does it. A First Lien HELOC, or the right First Lien HELOC, the bank was very specific that I had to say the right one because they were correct. I don't actually know if every single one works this way, but the right First Lien HELOC for the strategy calculates the interest payment differently. They calculate it using the average daily principal balance against your rate to calculate your payment. And what the average daily principal balance is it takes the average of all those individual days balances and it uses that average balance against your rate. So if we think about how, if you create a higher average balance, it's a higher payment. If you create a lower average balance, it's a lower payment. If you want the lowest payment, you have to create the lowest average balance. And so we know that. So it's like, how do we create the lowest average balance? Well, I've got a bunch of days. All those days need to be as low as possible. And you have the most number of days with the lowest balance. And so that's what we teach people to do, is to create the lowest balance for the most number of days, which involves starting with as much as you possibly can to put in there as fast as possible. And that leads into this first part of this velocity banking strategy, which is when you get paid, you don't deposit the money into a checking account or a savings account. You deposit it into your First Lien HELOC. And that pays it down as much as possible, creating the lowest balance as fast as you possibly can. Because I don't want to have a higher balance for more days. So I want to have the lowest balance now. And I'm not going to put some of the money in there to create kind of a low balance. I want to create the lowest balance today. And so you drive all the money in there, which sounds crazy to most people because with regular mortgages, if you put all your money into it, you can't take it back out, which means you got to eat food and you got to pay your bills, right?
Of course.
And so the fact that this is open-ended, the fact that money can go in and come out allows for you to pull money out to cover your expenses, which is exactly what you do. That's the second part of the strategy. Well, when you do that, it increases your balance. So if we think about 1 month cycle, all the income goes in, that reduces your balance. Then you pay for what your lifestyle requires. Pull out everything you need to pay for your lifestyle. That increases your balance. So at the end of the month, balance has gone down with income, has gone up with your expenses. Whatever from the income that month you did not pull out to spend, it simply stays in there, which means your surplus, every single dollar and every cent of your surplus that you don't spend pays down your mortgage month over month. So people that live below their means, that make more than they spend, people that are disciplined with their finances, it rewards that behavior because if that's the way that people function, that means they have a surplus. And this allows for you to leverage all of that to pay down your house. There's no money anywhere else. So essentially it's the fastest way to pay off your house. And so it's really as simple as subtraction and addition, subtraction with your income, addition with your expenses to figure out how much is left over. Well, that's your pay down. And so it's when people, and to kind of go back to the way I presented it before, when people's lifestyles align with what this strategy calls for, they can achieve some pretty amazing results in terms of reducing their balance extremely quickly, right? To a point where their balance is very low. If I think about making a transition from W-2 to a self-employed, position, right? If you can create a very low balance in your current mortgage before you do that, that creates an extremely low liability for you to be able to weather later on as you have the ups and downs of this new venture, right? Or this new lifestyle that you had. We can also, another practice that we'll do is we'll consolidate debt into here as well. which a lot of times your consumer debt, your credit cards, even auto loans, other installment loans, will have pretty high payments as compared to the amount that you owe. And so by consolidating debt to the First Lien HELOC, A, you can trade out higher interest debt for lower interest debt, which is a win. But from a cash flow standpoint, you can trade out liabilities that require a lot of expense each month and trade that out for a lower payment on the First Lien HELOC, which allows for you to increase cash flow, create more stability as you're moving forward as well.
Wow. So a mouthful there. I
That was a
love that.
lot. Yeah, I'm
Let me,
sorry. Yeah.
no, I'm
Yeah.
just, I process so quickly. So I'm right here with you. I
Yeah.
just know that I'm gonna, if I was listening to, I'm gonna go back and listen to this episode a couple times. So there are so many good golden nuggets that you mentioned there that it leads me to a couple questions, and maybe you could help me understand a little bit better. So let's say,
Definitely.
for example, I just moved into a house, right?
Okay.
Brand new, mortgage, brand new opportunity here.
Okay.
And from what I understand from a traditional HELOC, my mortgage balance would need to be, depending on what the bank's requirements are, somewhere between 70% to 80% of the appraised value of the property. Now, what I bought it at, but if I bought the house for 400 and it was worth 600, then, it's the house is worth 600, so they could give me up to 80% or
Mhm.
70%, depending on the organization, of a
Right.
line up to that amount. So if I'm looking at your product or this product, the First Lien HELOC product, if I bought this brand new house and I bought the house for, call it 480, and the house is worth 500, right? How does your product differ from a traditional home equity line of credit, because this one takes over the mortgage? So is that still some of the
Yeah.
similar requirements with the loan to value, or how does that work?
So if the home is worth 500,000, and we'll go to the other example, and let's just
Mhm.
say you owe 300,000 on the house. Well, that wouldn't be someone who just bought the house now, would it?
Potentially, it depends on how much money they put down. If they came from
Okay,
another
let's
house or
use
came from
that
another situation.
because right. So let's say you owe 300,000 on the house and it's worth 500. If you got a second position HELOC, you would keep your $300,000 mortgage and you would open up a line of credit. Let's just say it's 80%, which would bring the total amount that would add $100,000. So if they can go to 80%, they would open up a $100,000 line of credit that you'd have access to, which would bring the total amount, line plus current mortgage, up to 400,000, which is 80% of the value of the house. What our product would do is it would pay off your mortgage and open up one very large line of credit. We can go to 85% right now. We may be able to go to 90% pretty soon, but I don't want to make any promises that I can't follow through with. So call me in a month and I'll give you a better, hard hit on that one. But we can go to 85%. So what we would do if you went up to 85% on a $500,000 house, the line would be 425. It would have paid off your mortgage, which means now you would not owe $300,000 to your mortgage company because the line of credit paid that off. You would owe 300,000 on your HELOC, but you'd be able to go up to 425. So it would be one large loan that functions as an open-ended line of credit that would start with a balance of 300,000 because that's what it paid off, right? It would absorb that balance. But you'd also be able to go up to 425, which means you'd have access to $425,000 of equity that was not being used at that point.
Okay. Okay. Wonderful. And then what about the other example with someone that had that, brand new home with not a lot of equity in their house
Yeah.
yet?
So if someone, let's say someone put down 10% and they owe 450 on the house, right? We've had people do this where in that scenario, our first lien HELOC can go up to 85%. We can only go up to 425, right? But they owe 450. The way that you'd accomplish getting this is you'd have to bring 25 to the table at closing, or you could pay down your mortgage from 450 down to 425, and then you wouldn't have to bring any cash to the table. In both scenarios, you're not losing the money. You're losing the liquidity to the money because you're putting the
Mm.
money in the house, right? So it's still equity that you're gaining in the house, but you lose access to those funds, right? The times where it's people have felt like it's worth doing that and they've moved forward with that, bringing cash to the table to accomplish this, have been times where their budget and their cash flow, their internal cash flow for their household is strong enough where they're tracking to pay off their home in 5 or 6 years. So what it's for when they make that move, it's worth it to lose the liquidity for in this scenario, for that 25,000 to bring the balance to 425, just so I can get the HELOC and pay off my home really fast, because that is a much better outcome than staying in my current mortgage while it pays itself down. Because at the beginning, I don't know how much you guys have gone into the amortization schedule, but at the beginning of any amortized mortgage, the majority of your payment goes toward interest and a very tiny amount goes toward principal. The banks love that, right? Because every time you refinance, you go back to the beginning of giving them the majority of the payment. And so if you look at there's a graph that you can look at, amortized mortgage graph, that shows the percentage of money that goes to you essentially and the percentage of money that goes to the bank. And at the beginning of every amortized mortgage, it's the most to their favor and the least to your favor. And so this can sort of turn that to where you're actually giving yourself more every month. So in this scenario, you'd essentially, you'd be creating a $425,000 line, but you'd have to bring the cash to the table to pay it down. That's when it makes sense, is when the outcome is that much better for people.
Wow. Wow, that's wonderful. I really appreciate you clarifying that, especially for people like me that are detail oriented, that need to hear it a couple times. And I'm still going to go back and re-listen to this podcast so that way I can really get every nugget that you shared there. And I'm not going to forget that Louisiana piece. I'm going to go back and hear more about that while I'm back there listening to it. But let me ask you this. One more question here about this offering that you have here. What are some of the requirements that for someone's income related or someone's background? I don't know if you want to talk credit scores or that nature.
Yeah, no, absolutely.
What would that look like, for someone that's...
So you're going to want to have above a 680. Sorry, you have to have above a 680. You're going to want to have above a 700 for the best offerings, for the best terms. Let's see. The minimum balance that we are able to do is 100,000. So for someone that owes 40,000, it gets kind of difficult unless we can unless we can consolidate other liabilities to get us up to an amount owed of 100,000. Max is 1.5 million. I can go to an 85% max LTV. It does change at different valuations. Like once we hit 750 or once we hit $1 million, it changes from a risk perspective. It goes to 80 and then 70%. But our max overall is 85. I can't do Texas. I can't do Maryland. I can't do New York, Hawaii, or Alaska, which a few of those are personally painful for me, because I think that it would be really great if we could. Right now, that those are the state constraints. I can do primary residence only. For people that have investment properties, a lot of times I talk to investors who only want this on an investment property, and I completely understand. I get it. But what I try and do is ask them if they consider it with a primary and help them understand, help teach them how to accomplish the same thing that you would with their idea of how they do it with an investment property. You accomplish the same thing with it on your primary. And so, you mentioned earlier, you kind of touched on at the beginning, paying off your primary or helping yourself to pay off your whole portfolio with this. There's a way to leverage this. You have to understand the basic strategy, but there's an extension to it that you can utilize that we've taught investors to use to help them pay down and quickly pay off property by property by property by property much faster. So we teach it from a basic pay off your home primary residence, but this strategy with just one first lien HELOC on your primary can also be applied to a much greater scale to help people pay off their portfolio a lot faster. So it's an important thing to understand.
Wow.
And I can't do manufactured, mobile, or modular homes. So those are kind of the main sort of constraints that we have, or qualifiers. So one thing to know, you mentioned about getting started beforehand. One thing that our guidelines sort of require, underwriting guidelines, is that if someone is self-employed, we have to show 2 years history of their tax returns for that business. You mentioned earlier about, I guess, a book that Dustin had written about things to do before you take the leap. I don't know what the book is. Yeah. So,
how to quit your job in investment property with rental properties. Yeah.
And it sounds like, there's a section of that book that goes into things to do before you cut ties with your W-2. And because we require 2 years history of tax returns, that means that this is probably one of those things that if it's something that someone would want to do and they're planning on going into a self-employed realm, you'd want to do it before you went into the self-employed for a number of reasons. One is because if you do it once you're self-employed, you got to wait 2 years. That's a pretty easy, black and white thing, right? There's another reason I think, which is the security piece, right? If you have in that scenario we talked about, you have a $500,000 house, you have a $425,000 line, you owe 300 on the house, you have $125,000 of cushion, right? Now that can't be a slush fund. I mean, it can, but you'd ruin yourself if you treat it that way. So I'm going to say you shouldn't and can't do it. But what it can do is serve as security for a household where there are some unknowns. I know that I've been in a very, very tight financial season of life before, and I didn't react to the stress as well as I would hope. And so the HELOC that I have, things are different now, right? From a financial standpoint for my family, but I also know that forget 6 months of reserves, right? I've got like 4 years worth of reserves in available equity in my home, right? That if something happens, I know that we'll be fine for as long as I need to get myself back on my feet, right? And so there's a lack of anxiety and a lack of worry. Right? It doesn't help me be more confident, but it helps me with that anxiety side of things where it's like if something goes wrong, I don't know what's going to happen. Well, I don't know what's going to happen, but I do know my family's going to be okay. And so there's a big piece to that, which has helped me personally, right, in terms of moving forward and having a forward vision of where we want to go as compared to worrying about what's going to happen. If that makes sense.
Wow, that's wonderful. Wow, and thank you so much for sharing this information. I know that it's been completely eye-opening for me. I feel guys got some
Thank
continuing
you.
education credits. I'm not in the real estate industry or in the mortgage
Yeah.
industry directly, other than my own personal investments. But I feel like if I was a realtor, or that I just got some really good information there that I could use and add value to all the wonderful people that I'm helping. But Anthony, I want to ask you a couple questions here, kind of rapid fire.
Yep.
Just things that I think would help to the people that are on that journey becoming successfully unemployed. I would love it if you could share with them maybe a book recommendation, nonfiction, something that has really spoken to you on your journey, because you mentioned that you had a fourplex, right, and then you end up going into a 32 unit. I mean, oh my
Yep.
goodness, how amazing is that? You were a musician, you went and pursued that dream. There were a lot of different things that you did. You also sold and originated mortgages, which is very entrepreneurial. A lot of the
Yep.
guys that I know that did that were 1099, commission only,
Mhm.
and they cleaned up. They did very nice for
Yep.
themselves. So what would be a nonfiction book that you could recommend, something, or even a nonfiction piece of media, something that you think would be really good for the person listening to this right now?
So I'll give you two. One helped me from an efficiency standpoint drastically. The 4-hour work week. That one showed me strategies and tactics to make my work extremely efficient, and it gave me processes to fall back onto to make my work and just make me extremely efficient in terms of time. And that helped a lot. Another one, I've got a couple. I didn't know which one I wanted to talk about, but I'll say Failing Forward. Failing Forward was a really good one. The hard part about entering into an entrepreneurial type role, whether it's a W-2 sales commission only, right? Or whether it is real estate, or whether it is a business idea that you're trying to get off the ground, you're going to run into challenges that no W-2 salary person is going to run into. And like maybe that's just me, but maybe that's happening. But if you're anything like me, that's going to happen, and it's gonna rock your world, and it's going to blindside you with how challenging it is, right? And there's a lot of pain that's involved with it. And so, Failing Forward was a book that allowed for me to sort of re-envision what failure means in terms of using it as a learning curve. Another book that's sort of in line with that is called Mindset. It talks
Mm,
about growth mindset. And so those two kind of line up with each other, where you either recognize failure as a growth opportunity, which is what the book Mindset talks about too. It talks about more about the approach to how you think about situations. But both of those I think, were really good books for me personally, to help me objectify or have more of an objective viewpoint of failure instead of a subjective one, to internalize it as me failing. It's more, I'm supposed to fail because I don't know this stuff. Now I know a little bit more. So,
Wow, that's amazing. I really love that you shared Mindset, and I believe that's by Dr. Carol Dweck. I read that
yep,
book and it changed my life because
yep,
it has helped me to see that it's the frame of mind. A friend of mine years ago did this exercise where he said, Roger, stick out your right hand. And I stuck out my right hand. And then he said, Roger, stick out your left hand. And I stuck out my left hand. And he said, okay, now bring both hands on the side of your head, right in between where your head's in the middle. He said, okay, the problem exists between your hands. It's
yeah,
all in the way that you think and perceive your world and your reality. And if you can understand how to fail forward, if you can
yep,
understand how to have a growth mindset instead of a fixed mindset, if you can
yep,
understand how to better plan your time for your week, that maybe this thing that you've been taught your whole life about how to work and how to be efficient, maybe some of those concepts could use some readjusting, then
yep,
perhaps you could change the challenge that's in between those hands and you could really see
yep,
measured success. So I'm so glad
absolutely.
that you shared those books. I look
Mhm.
forward to reading a couple of them. I have not read Failing Forward. I've heard
Yep,
of the 4 Hour
that's
Work Week, but
good.
after this conversation, I'm going to really need to pick it up. I've heard that 2 or 3 times now, and it's on my top priority list. So
It's great. It's really good.
Anthony, I've been so honored to have you on the podcast here today.
Thank you so
I
much.
know this is going to bless so many people. Anthony, you've given us a full education. Now, please help us understand, how can we find you? How can we get in touch with you? How
Yep,
can we learn more, whether that's either picking your brain or getting some more resources? How can we move
yep,
forward with the product or the service that you have to help us to be able to reduce our debt, reduce our
yep.
expenses, have some cushion, and to be able to be better prepared to be successfully unemployed?
That's a great question. So the best thing to do is to go to firstlienheloc.com. And I know I'm not sending you to First Savings Bank, but firstlienheloc.com is a free educational resource that I am involved with. I help them and I help to sort of guide what they're doing and the content that they put out. And read through there's a First Lien HELOC 101, there are testimonials, there are what if scenarios, and if you want to see if it works for you, in the top right of that homepage, firstlienheloc.com, there's something that says run your numbers. It will bring you to a First Lien HELOC calculator where you can put in the balance of your home, you'll input your income, that your take-home pay, your current monthly expenses, and it'll tell you whether this is a good fit for you or not. It'll give you a projected payoff time given what you put in, right? Given your income, given your expenses, given the amount that you owe on the mortgage, and it'll calculate and tell you the projected payoff time, the projected interest cost savings that you could experience with that budget. That's one place. And then because I'm the sales manager here, I was the first originator here. And then we added to the team. And so now I'm the sales manager. I drive and run our team. All our team does is First Lien HELOCs. So I hope this doesn't come across as arrogant. I would put our team in terms of this particular niche strategy and product. I would put us along, not up against, but along with anyone else in the country because we don't have a conventional loan. I don't have a VA. I don't have an amortized. I don't have anything else to offer other than First Lien HELOCs. So I guess by default, we have to know about this, because we're not diversifying. We are specialized. And so in the top right, there's another button that says get a FLH, get a First Lien HELOC. What that'll do is that will ask you some identifying questions and bring you to a calendar that will book with one of the 3 loan officers on my team. And what they'll do is they'll walk you through the strategy again. They'll run your numbers to make sure it works again, and then they'll help explain the product that we have. And if it's something you want to get moving with, they can help you do that. I personally would run the calculator first just to make sure you can double check that. And then if it works, then I would book a call with one of us to help reintroduce or help fill in gaps in understanding. But firstlienheloc.com is going to be one of the best places to check out, to get in touch.
Wow. Action item number 1, go to firstlienheloc.com and get educated. Anthony, this has been phenomenal. Thank you
Thank
so
you.
much for coming on the show today. Thank you so much for adding so much value. You said it without saying it. The riches are in the niches. You've niched
Yeah.
down your product. You've niched down your service to where this is what you do all day long. So if there's anyone that was looking to learn more about this, you're the place to go. So very excited to have you on the show. So glad that you're
Thank you
able to
so
hit us. And I sure hope that you have a phenomenal rest of your day. Thanks so much
much.
for being on the show.
Thank you, Roger. Thank you so much.